Hey guys, it's Chris Mincola with the Mincola Group over at West USA Realty, and I'm doing our weekly market update. Hope you guys are doing well. All right, let's jump right in. I've got some serious stuff to talk about here, some fun stuff, some stuff that maybe makes more sense out of what's going on in the market right now. So here we go. Last week we had the entire world kind of go nuts over a 0.1% overall difference in inflation, which kind of came from rent prices, which is about 44.4% of inflation data. Um, and That was pretty flat. But OER, how they basically figure out rental costs and things like that, which makes up the shelter costs and rate of increase of that. That rents data was up. Um, so we'll be stuck in kind of this back and forth for a little while with that rent stuff and inflation. And of course, they do keep spending a lot of money in our government right now. And that means it's a lot of, anytime you see a program for this, a program for that, those are inflationary factors. So if it's, paying off student loan debt, subsidies for Green Deal stuff, all those sorts of things kind of make up those inflationary factors because that money's got to come from somewhere. And if it's not coming directly from oversupply of tax dollars, which of course I can't even remember how many trillion dollars in debt we are right now, but trillions and trillions of dollars. It's like 1 trillion uh, every 100 days now, basically, that's being added to the debt, which is not sustainable. They're gonna, at some point, they're gonna have to get some adults in the room to kind of figure that out, and that's the fault of Democrats and Republicans. But that's a whole nother thing. But that is, due to all that spending, all that debt. Uh, but a trillion every 100 days, it's a service debt. It's not sustainable. But that said, we'll see how that all goes. But basically, this means at this point we are now looking at uh, not three rate cuts this year, but maybe two. Okay, maybe two this year. And I say that with a big maybe. Okay. Because at this point, with the way things are going, I'm not convinced that I think rates are going to kind of just get stuck where they are. And I talked about this before. I did a short video on this before that I posted out there and sent out in their weekly email a couple times. But if you go back in each decade, you'll see that that rates usually hang right around kind of a middle range. Okay. If we go back from 2000 2010, you'll see that they kind of hung around 6% if you go back another 10 years and look at that decade from 90 to 2000, they hung around 7.5% and so on. So we've always got this kind of decade thing that happens. And for the foreseeable future right now, I kind of see rates staying at the higher levels. All the more reason you want to be working with a mortgage broker. All the more reason you want a strong buyer's agent. All the more reason you want a seasoned agent to help you, whether you're on the seller side or buyer side, to figure out concessions and all those sorts of things and when it makes sense and all that, so that you can actually, if you're on the buyer side, maybe get a buy down rate. You can get that a lot right now. With a lot of sellers are offering that, a lot of builders are offering that. On the seller side, you just kind of want to be aware that that's a thing. And I'm going to talk more about that here in a bit on the concession side. But that is something that, is just going to be kind of a thing that's baked in. And, when they figure out these rents and the rate of inflation, it's a thing that was changed a while back by how they kind of, figure these things out. So by the 80s or so, um, they were using this basically surveys of what people think they could rent their property out for, that own a property. That's how they figure this. It's kind of a weird way of doing it. Now, before, they kind of looked at more what was baked into people's home prices, and the interest rates that they were paying, which a lot of people feel is a more accurate picture um, of what would be the actual rate of inflation for shelter costs. And from that standpoint, um, people have done, they kind of build these charts out and stuff that show that the overall baked in inflation, when you look at things like a home and car, which are two of the biggest expenses most people have, and you look at the rate of um, the interest rate that they're paying on those things right now, um, our inflation data would actually show about double what it does right now, and where it was at its height. So you take that for what you will, but these, way that they check these shelter cost increases are done through survey. Um, there also are some other data points that come off of that they use that are a little bit more accurate, but this is what the Fed is going to go by. So uh, and the reason why I mentioned earlier we're looking at maybe two rate cuts instead of three this year is this inflation ties back to the bond market and the 2-year yield. Okay. The thing to watch is if this 2-year yield gets to 4.7%, the Fed takes off a rate cut and the 2-year yield went up, 20 basis points. This thing moves like crazy. It's pretty volatile. But if that hits 5.2%, all the rate cuts, that 2-year yield hits 5.25%, all the rate cuts are gone. Okay, for this year. So keep an eye on that. We'll of course keep you updated here. If the mortgage splits were where they were last year, the rates would be that you're seeing on TV, not what you could get through a mortgage broker, but the average rates that they show you on TV. Those are the averages. Those would be at 8% right now. So those mortgage splits are kind of where we see things with the 2 and 10 year yield, where they end up in the mortgage arena, is always higher because they're obviously going to be making money on those mortgage backed type of things. So when we say splits, that's the mortgage splits, and that what it's costing to borrow money, basically the cost of money, and the money they're making off of it. And those splits are usually, I don't know, typically about 1.5, maybe 2% difference. And they were a lot higher, but those splits are getting better. If they were where they were last year, we'd be at 8%. What you see on TV, the TV average rates, those retail rates, not what you would get through wholesale market or mortgage broker. So the 2-year goes with 2-year goes with headlines. It's very volatile. It shifted when we were supposed to go into a recession last year, according to the bond market, and then we had the banking crisis, and that was used by Jerome and Janet, Jerome Powell and Janet over at the Treasury, and earlier this year, the bond market was saying 5 to 6. The bond market was saying 5 to 6 rate cuts. The Fed said we never said that, and they didn't. So that's what people kind of thought was going to be baked in, but that wasn't the case. So and also with with the banking crisis, we also had uh, um, two of our credit ratings, two credit rating decreases, okay, in our credit ratings. So all that causes all this volatility and all these problems too. That's another thing that's baked into this. So the Fed was saying, maybe 3, not 5 to 6 like the bond market. Uh, Now, at this point, we should hopefully expect 2 Fed rate cuts, which will indirectly affect mortgage rates through the bond market, but we'll see. The Fed doesn't have to use the CPI data. They don't even use the CPI data. I mean, they use the PCE. Okay, so when you see all this CPI talk, it's certainly something that they look at. But they normally would go by because of the headlines. Okay. And again, that's more like that 2-year yield. But the PCE inflation numbers, when they say their target is 2% inflation, it's based on PCE. And more than this, the Fed is watching the labor market and wage growth of the labor market. They are going to wait longer because of jobless claims, because the economy has performed better than expected, which you can argue with that, but for the numbers that and the revised versions of this and that and everything that they're showing right now, it's performed better than expected in the Fed's eyes, even though they're not even quite too sure of that. So that's kind of why they're waiting. They haven't said before, Powell, what which Powell hasn't said before, about the jobless claims. Okay, but he finally said they follow the jobless claims, which of course is a thing, and they would and should, but they have gone lower, and that is exactly correct. Okay, so um, they will push this until the labor market breaks. Okay, they will push this till the labor market breaks. So don't expect any rate cuts June, July, anything like that. Maybe third, fourth quarter of this year, we'll see. If the jobless claims came out, last week, this week, with the 4-week moving average at 323,000, we wouldn't even be having this discussion. The 10-year yield and the mortgage rates itself would go lower, but now with GDP and retail sales coming in higher with the revised estimates this week, we are where we are. So the one detriment this week, though, was that the housing starts data is starting um, the frontline forward looking data, um, what a recessionary line would look like many months out, but the Fed thinks they have time. Okay, so they're just going to kind of sit and wait. And let me explain what that means. So how much looking out, seems like the labor market will soften enough by the end of the year into 2025. Okay, looking ahead. So until they feel the labor market and the economic data forces their hand, they're going to stay right where they are. Okay, they're going to stay right where they are. So for the most part, with this last week's crazy stuff, um, that's about it. So softening and breaking are two different things. So keep that in mind. So if the 10-year yield in the bond market, if the 10-year yield is, it's going to be sitting right around 3.8 to 5%. And the spread will put us between, with the mortgage spread there and what the costs to borrow money. We're looking at 6.7 to 8%. Okay, or high sevens. To break below 3.8 on that 10-year yield. And it's important, you understand this stuff because it's what drives these mortgage rates, right? And that's what everybody's sitting on. So if it breaks below 3.8 on that 10-year yield and the labor market breaks, or the economic data breaks, the mortgage spreads are better. So that's good and keeps things better overall. And that means when that 10-year does break lower, we'll be in a better position. Okay. And if the spreads get even better, which they already have since last year, before that, we could see, some lower rates, possibly some lower rates. And that's why we look at this stuff daily and weekly and forward looking. So, now the apartment boom's pretty much over. So that will level off a bit, catch up, and as far as the supply and demand, and then create a bit of a lower rental inventory situation eventually down the road over the next year or two, maybe 3 years, when all these projects that were started are kind of filled up and completed and filled up. And we may see a slight bump in rents in the next year or two, maybe 3 years. Because people sign their leases and then it's going to be a year or two out. So could even be up to about 3 years. But eventually, when those construction people that are building those rentals are out of work, um, and that won't translate them going from those projects over to single family sales. Okay, for the most part, for the greater majority. So when they lose their jobs, that's always the start of the recession. Okay, when you see construction job losses, that equals jobs losses in construction, that leads to recession. Always leads to recession. Okay, so keep an eye on that too. We'll keep an eye on it. When you start hearing layoffs in construction, that begins the recessionary cycle. Always. Okay, always. So it's not inventory holding sales back, it's mortgage rates. We have more active listings this year than last year, and again, countrywide, and new listings data is growing year over year, slowly but surely. Okay, there's a potential to have more sales this year if mortgage rates do fall. So we'll see how that all turns out. All right, so now that we've got that out of the way, I am going to go ahead and shift this over. For you so I can share my screen with you here. Hopefully that all made sense, but keep an eye on those data points that I mentioned. Um, so again, inflation remains stubborn. Notice here it says remain stubbornly high, driven by energy, shelter, and motor vehicle insurance. Okay, because that shelter cost came in a little bit higher than expected. But again, it's that 0.1% difference here. Look at that 3.7, 3.8. Okay, the annual reading remained at 3.8, though it was expected to decline to 3.7. That's what everybody expected. It didn't happen. So, the energy and shelter, I mentioned energy before. And again, the more oil we produce and refine, the better off we're going to be. Why? Because that means that it drives oil prices down, especially if we're doing it ourselves. Okay, so the more we need permits to do that. Okay, so the government has to open up those permits. They kind of held that up for a little while. That has slowly changed, not as much as I'd like to see, but again, when you're throwing in all these green energy policies, and a lot of that is very expensive stuff, a lot of it isn't as sustainable as coal, or to run these plants, you've got to have nuclear power, you've got to have gas power, diesel power, you've got to have coal power. So by the time it gets to the electric car, there we are, and that electricity that runs your AC, is all powered by that. Okay, if you want steady, uh, all the time energy, and that has to, our grid has to really be increased. Um, so without getting too far into the weeds on the energy thing, it definitely is a factor. And when you have to subsidize, when you have all these subsidies on these things like green energy, this program pays for solar. This program, is giving you an incentive to do this. All that those are all inflationary factors. That means you're going to pay more at the store for all this stuff. If you're not producing enough oil, it's going to cost more. It's going to cost more to ship everything, to truck everything, to fly everything, whatever. To move stuff, it's going to cost more money than at the grocery store or at the department store. Okay, or to have it delivered, or whatever. We talked about shelter costs, motor vehicle, and insurance. Insurance has gone through the roof. I think it's like 20 or 30%. I can't remember the exact number, but it's insanity what's going on with that. And there's a lot of speculation on why, without getting too far into that too. We've got a lot of issues in insurance right now, but that is in a nutshell that inflationary data. Now, the one thing is, let's see, where is it here? Doo-doo-doo-doo. I had it here for you. Where'd it go? Okay, maybe not. Oh, I thought I had it saved here for you. Okay. Anyway, I'll find what I was looking for. But maybe it's on there. Okay, well, let's look at this. So the 2 year, remember I mentioned earlier, we want to make sure that we are watching this 2 year yield. So if that breaks, that broke at 4.74, that's went above that. So we're taking one rate cut off. The 2 year yield, if it breaks above 5.25, um, we've got a problem. We're looking at all rate cuts off the table for the year. Okay. That's how it will work. Now, the 10 year treasury right now, um, you know, remember last year that went up to 5. That brought us those 8% interest rates. So we want this to come down. We'd like to see this, like we said, closer to that 3.8 mark. We get down below that, that's when we're going to start seeing some rate cuts happening. Um, we talked about the splits being better. Now the mortgage rates today, again, they kind of been up and down a little bit the last couple days. But 30 years, these are the average that are taken out there, the average kind of thrown together for the retail sector of the mortgage market. Again, if you go through a mortgage broker, you're going to get much lower rates than this. I had somebody last week that was under contract at like 5.5% on the house they just bought. So for what it's worth, let us put you in contact with somebody who's going to be low fee, um, and not charge you an arm and a leg, and give you the best rates. Okay, no junk fees. Right now in the Phoenix area, this is our inventory. Okay, that's our total inventory of all property types that are active, not under contract, but just active. Okay. New listings were down a little bit. I'd like to see this number right around 2,500 typically for new listings taken. The distressed, lender owned, HUD, those are all down. Short sales were up a little bit. Be careful when you hear about people saying, oh, the foreclosures are going way up and the sky's falling. I've talked about this before too. But the number of short sales in our MLS were like 42. We're seeing like 19 lender owned. Those, are these distressed type properties that we saw during the crash. There's like hardly any of them. So when you go from nothing, like I said before, after in the past, when we came out of COVID and we had that whole moratorium there, the percentages, of course, are going to be high, but the actual numbers and the actual on the ground data, uh, big difference. Okay. So one thing I wanted to bring up too is people are wondering why are prices going up so much? And again, I've shown this chart before, but right around mid 30s, people start buying houses. Okay. Um, so when we looked at Generation X and we looked at the last crash that we had, that housing crash that we had in 2008, we saw that we were low on demand. Part of that was the population. Okay. And taking that out, and because abortion started in 1973, and you take that out in about 34, 35 years, and we ended up where we ended up. Now, for the millennial and even into post millennial, eventually looking downstream, we've got a steady supply of people who are going to want to buy homes. Now, there's an argument about a lot of people wanting to rent versus buy right now and all that. I've shown you all the charts before. We've gone through this before. I will say this, if you're going to be, I was talking to somebody today and they said, well, should I buy? Well, okay, general rule, if you're just looking for a place to live and you're not really thinking investment, which you really should, but let's just look at that first. First of all, if you're going to be in a place 3 to 5 years at least, I would definitely buy. Okay. Got to keep in mind having rent is not cheap these days. And rent is 100%, as far as your interest rate is concerned, because all that money goes out the door. Okay. Over the years, there's really only been maybe a total of 5 years we can look at and say, well, okay, one or two of those years might have been kind of even, as far as equity gains. Um, if at worst, and we had those, 3 or 4 bad years. So about 5 years really where we could say the housing market wasn't that bad, but we've got a steady stream of demand coming at us, and we don't have an overabundance of supply like we had during 2008. I mean, look at this. You had kind of a perfect storm, and it makes sense when you stop and think about it and really analyze it. You had this lower number coming in, but you had a giant number of people who actually, um, were looking at the inventory. Like in a Phoenix area, we were at like 58,000. Across the country, we're almost at 4 million in supply at that time. Okay. Um, so right now, across the country, give or take a little bit, depending on the year, we've been kind of running right around 1.2 to 1.4. Um, and usually the demand is at least a couple 100,000 at least higher than that as far as the demand. And that's going to be going up or staying pretty steady as far as the demand goes. Also, you know, as far as just general break even, like those 3 to 5 years, definitely you're going to, come out ahead with your equity gains. You get your compound interest going. But, also maybe you buy a small place or maybe you buy a duplex and you think long range investment, you think 1 to 2 years, I could, live here in this smaller property or duplex, rent out the other side, or in a year or two, rent out that property and then move on to my next and then just keep building from there. There's plenty of people that do that. They stay in a property a year or two and then just kind of move on and they just keep doing that. That alone is going to build your retirement long term. That alone is going to give you what Einstein called the compound interest, which is the greatest wonder of the world, really, the way he explained it. So this is just something to think about, to keep in mind always, is real estate investing long term. Rentals give you cash flow. Somebody else pays down your balance, right? You certainly have to do it smart and know what you're doing and all that, but that's where your expertise of somebody who's in real estate like us could help you out. So in any case, it's a fact that homeowners have more money than renters. Okay. How much? 40 times more. Okay. And that's looking over, 60 years worth of time. So when somebody asks me, um, you know, should I buy? Yeah, there's a whole lot of reasons why you should buy in pretty much any scenario. Now, sometimes, somebody's moving from one state to another, they're not sure about the area or whatever. I get that, I get that, but it's just something to keep in mind. Okay. Um, right now, what the Cromford Market Index is telling us is anything over 110 is a seller's market, anything below 90 is a buyer's market. We're at 111.4. A couple days ago, we were at like 113 on the index. Uh, we're pretty much in a balanced market, guys. A slight advantage to sellers, but I told you this was coming. And here we are. Until these rates kind of change up, or unless there was some kind of great supply of homes that just flooded the market. Okay. Um, so that's kind of where we are there. The other thing is, as far as, you know, our our property totals as far as sales and everything, we are definitely higher than last year. We are a little bit below where we were a couple of years ago. So, again, it's just kind of hanging there, balanced, nothing crazy. Everybody, I know a lot of people are running around, skies falling, crazy stuff happening, this and that for them clicks on the internet, but it's not any of that, guys. They're not seeing it. Um, when you have low supply like we have, okay, I showed you earlier we were at 17,000. Again, when we're at the crash, we were at 58,000 homes for sale. Okay. We're nowhere near that. And we have more demand. And we have more demand. Okay. Um, and the builders are not going to overbuild. They're not going to do it. They're going to look at their bottom line. They're going to do what's right for them, because they're running the business. And there isn't going to be this some sort of great surge there that's going to happen. So, and that's really the new inventory, right? That's really the fresh inventory that when we talk, because usually when somebody sells a property, they're typically also buying a property, right? They're moving from one place to another. They're not living in a tent, okay, when they sell their property, okay? So that's kind of a, neutral or net negative. So yeah, per one other thing, percentage of closings with seller paid concessions. Um, those are definitely up. Right now, like Litchfield Park is at 62%. We see Tolleson at 83% paid seller concessions. Okay. It's definitely a thing right now because people are thinking about, I want to buy down my rate, buy down my rate. And again, with a new build, a lot of them are offering all kinds of incentives for this. The Phoenix proper is doing 48% right now, Gilbert at 49%. Um, we see Buckeye at 67%, Avondale at 72%. Um, let's see, Surprise is at 48%. So those are just a few there, guys. But yeah, the seller concessions is a thing right now, and it's going to be at least through the end of this year, a thing into the beginning of next year anyway. Um, let me see here. The cities that are in a seller's market right now are Chandler, Gilbert, Glendale, Tempe, Mesa, Phoenix, Avondale, Fountain Hills, Scottsdale, and slight seller's market, Peoria. In a balanced market, we're looking at Paradise Valley, Surprise, and Cave Creek. And then Goodyear, Queen Creek, Maricopa, and Buckeye are all in buyers markets. Okay. So I think that's all I've got for you guys today. If you guys have any questions at all, feel free to reach out to me. On the ground, I can tell you this. We've been busy. We've seen a lot of people coming through open houses. We are seeing, it's just the time of year where showings pick up. Is it as busy as it was a couple of years ago? No, nowhere near that. Um, I would say, you know, I always like to price a property correctly if I were going to list a property. Um, but it would be, I think, a smart way to go with these higher interest rates right now, and very, very, all this volatility going on. We were all the way down into the mid sixes not that long ago, right? Beginning of the year, everybody had a lot of hopes, you know, and again, if people knew about mortgage brokers more, that's why I always mention it. They could get better rates. But most people right now, they hear all this stuff on TV about these higher rates. You can get lower rates right now. We can negotiate those things in for you when you're going to buy a property, especially in the new home sector. We can help you with that and negotiate really good deals there. But for the most part, if somebody's dealing with, a retail lender out there, um, they are going to be paying a higher rate. They're going to be paying more in fees. and that just cuts into what they want to make on a payment, obviously, and that also does make a difference on what they can afford from a max budget, max qualification. So keep those things in mind. Please feel free to reach out to us. But when you're going to price a property right now, you look at the appraised value, depending on the area, depending on the traffic, depending on the property, and all that. Uh, we always like the price by brackets. If you look at every portal out there, you go to Realtor.com, Zillow, all the third-party sites that, are fun to play with. They don't always have the most totally accurate information. They don't have certain functions that we have on the MLS. And of course, they don't have the back end information that we have as realtors. But when you go through there and you do your searches, it's usually going to be in typically, most of them, it's going, especially the most popular ones, they're going to be set up in like 25, 50, $100,000 increments. So when you price a property, number one, you want to be priced even numbered. That's kind of how people get qualifications too, but that's how they search for homes. You don't want to price a price. We're not selling soup cans here, right? So the best advice I can give is, you know, if a property's at 599, okay, what about that person who's looking at 600? So if you price your property at 600, okay, if that's what we come up with for the pricing strategy, you're now the Taj Mahal of the people who are looking, from 500 to 600 or 550 to 600, or you're the best deal of those people looking from 600 to 625, 650, 700, right? So you're the best deal in that case. So uh, it's really important to do that because, unless we're playing games with like, big luxury, we're talking, two, three, $5 million homes on up. Certainly we can play around with the numbers if you want a little bit more. But, when we're talking, the average priced properties or upper average, you know, you really don't, you don't want to lose out on a buyer pool of people looking that way on these portals in 25, 50, $100,000 increments because you priced your property $100 less and they're not seeing it at all, okay, on their portal because they're, looking from 600 on up and you price it at 599, 990, or for $10 difference. You don't want to do that. So, really, really good. That's one of the best things I could kind of put out there. Another thing I would recommend is talking about some of the different marketing strategies that an agent can provide. Not only professional pictures, but the way the pictures are taken. I'm not going to give away any secrets here um, right now, anyway. But feel free to reach out. We can talk about that, talk about video, all these different things that we can do to get out there and market properties, and other strategies that really work well. Some of those are new high tech things. Some of those are the usual stuff. So yeah, guys, reach out with any questions at all. If you're having any questions or any issues with not seeing what you want to see, not getting the pricing you want on your mortgage, not looking at, getting your property sold. So anyways, we'll talk to you guys soon. Hope that information was helpful. And if you guys have any questions, feel free to reach out. Thank you.